Good morning, everybody. It is May 1st, 2020, and the April stock market rally appears to be over for now. So let's talk about some ideas that we should really have at the top of our head, and let's really get to understand what's going on with coronavirus, COVID-19, and the economy, and how that likely will reflect on the stock market. I have showed you a lot of charts the last several weeks. I'm not going to rehash some of those, but what we know is that the stock market is very likely to have another correction here. We don't know how big it will be, but I suspect it'll be fairly large. And I don't know that we're going to retest the lows as far as meeting it exactly. But if I had to make a wager, I would say that sometime in the next few months, the stock market sets new lows. And when that happens, we are going to want to get very involved in our favorite industries. The possibility exists that the Federal Reserve can print so much money that maybe we don't go through the previous low and we see the stock market stop a little bit short of the previous low and then start a less robust rally. I don't think that we'll see another V-shaped rally without a healthcare miracle, but that's possible too, so we have to keep an eye on that. So why don't we get started? I have put together, I think, a decent presentation, and I will make this available to all members of the investment letters on Saturday with the chart book attached to the end. Right now I don't have the chart book in here because I want to give members a very good heads up on what we think that we're going to want to do. Next week on Tuesday, we will actually do the stocks on Tuesday, again for members only. And I was going to do that today and back-to-back, but it looked like this was going to take almost an hour, and I didn't think anybody wanted to be on with me for 2 hours. So we'll do all the stocks on Tuesday, and that'll be members only. So let's get started. I hope you all like the pretty cover that I got. So when we look forward to a path from coronavirus, COVID-19, we need to understand that time ultimately really impacts investor expectations and how the economy moves. So this year we'll probably see cascading economic destruction that's met by massive policy responses. We've already seen that between the Federal Reserve and the Treasury. We're looking at over $6 trillion meant to prop up what looks like a $3 trillion loss in GDP. Now, a few weeks ago, I suggested that you should really think that through. Why would they need $6 trillion to backstop $3 trillion? And the answer is all the interconnected transactions through the debt markets, which are on thin ice. We talked about that way back in January. Into 2021, we'll see lingering economic weakness. We won't get the V-shaped recovery, which I'll cover soon, because there's not going to be mass vaccines by early next year. Sometime next year, we'll start with mass vaccines, it looks like, and we'll cover some of that too. But the reality is that all the policy response is probably going to create monetary financial pressure. Also, we'll probably start to see, excluding oil, we will probably start to see some resource scarcity. We're already seeing it with the food supply, which is the most dangerous place to have scarcity, right? So we don't want these things to get worse. my expectation, anybody who was around back in the late 1970s, this won't be as bad of a stagflation as we had back then. However, we are going to see perpetually high unemployment, slow economic growth that doesn't get back to 2019 levels until at least 2022, and maybe not till 2023 or 24. But at the same time, purchasing power probably goes down a little bit sometime either very late this year or next year. In the meantime, the dollar is going to be very strong, as I can show you on some charts when I finish this up for you, actually when I just attach everything. And what we believe is, or what I believe is going to happen, and when I say we, I belong to a lot of other services, and I pick and choose what I think is right. I think, and people that I listen to think, the dollar stays very strong to the election. This is something that I've been talking about since October, November of last year. The election is going to be a pivot point for a lot of things, just like it was 3.5 years ago. So I believe that the worst is between now and the election, and things start to get better after that, although the ramp up really doesn't occur until we can fully open up the economy in a way that doesn't create even more deaths. So the big economic recovery, I believe, isn't until 2022. Sometime in 2021, the stock market probably reflects that, which means that we have to invest somewhere between this year and next year. So this is a neat graphic that I was able to put together with a couple of new data sources that I'm subscribing to. And what we know is that New York was the hardest hit state, followed by New Jersey. And then there's a group of states that also got hit pretty hard. New York has had some good news. The death rate's been falling, down to, I believe it was 56 deaths a couple days ago. I think that's what that number is there. And as the city of New York gets down to the point, that's just an incomplete bar. But as the city of New York, I think, gets under 10 cases per day, that becomes a very good leading indicator for the rest of the country. As you can see, their curve hit an inflection point about 2 weeks ago, where the increase in deaths, the rate, started to decline. So as this gets horizontal, that's what we want to find. We want to find that nationally. The problem is that nationally, we're not sure if that's going to happen just yet. Reopening the economy in some states too quickly could make their curves bend the wrong way. So the goal is to have the death rate, and the reason I focus on the death rate is because it's the ultimate outcome. And it's very difficult, given the lack of testing, to know how many infections there are. The estimates based on data are that there's 5 times as many infections, give or take, as what we are seeing in the official numbers. So that belies a couple of questions, one of which is, how good are these antibodies? But we need this curve to go almost horizontal, and we're not anywhere close to that yet. The number of deaths as of today is over 60,000 in the United States. Remember, just a month ago, they lowered their estimate to 60,000 for the year. And we're at 60,000 on May 1st. So right before Easter, I told you that I was worried about all the people planning to go to Easter Mass. In the last couple of weeks, I told you I was worried that southern states were going to open up too early. And we had hoped that with the success we found in New York, city of New York, the state still is working on some things, but the city of New York obviously is a harbinger, I think, for everywhere else. If the city of New York can conquer coronavirus, everybody else can, because nobody's as densely populated as them. Death rates started to fall, coinciding with New York starting to fall. Easter masses got a surge. States in the South, a couple of them in particular, started to open up, get a surge. My concern is that these southern states spur a larger first wave of the coronavirus and COVID-19. And this is something that's shared by Dr. Fauci, everybody at CDC. You can find any healthcare researcher out there, and they're telling you that we don't want these curves to bend the wrong way, because if they do, not only do a lot of people die or possibly have permanent organ damage, which we've seen now, but it could necessitate stopping the economy again, which would be far more damaging than simply stretching out the reopening an extra month or two. Keep something in mind is that when we measure the death rates, there's skepticism out there about how many people are really dying. What we know pretty decisively is that the official numbers, that 60,000 number that I showed you a second ago, is underestimated by about 50%. How do we know that? We know that by tracing the number of deaths against other years. So in 2018 and 19, there were a certain amount of deaths this time of year, and you can go across all of these states, and if you go to the New York Times, you can actually see the updated charts for the whole planet. The number of deaths above what you would expect jumped significantly. Because the hospitals, other than New York City, didn't get overwhelmed, most of those deaths were probably COVID-19 related. Is there some people who didn't get treated for other things? Certainly. However, the vast majority of the deaths actually happened at home and in nursing homes. So this is a problem that we need to keep an eye on. These curves also need to flatten and then come back down. Some of the other curves don't. This one will go down. This one you just want flat, right? That's total number. So you want the total number to stop going up. Have a horizontal curve there. So the problem with the southern states opening up, and really, in my opinion, being hardheads about a lot of things, is that do any of these curves look like they're flattening? Now, some of these aren't doing so bad, mainly because they haven't had a ton of tourism, and they just didn't have a lot of early exposure. But South Carolina, you can see, which was one of the first ones to start opening up, it's had a tick up. Texas, it's been pretty constant. Louisiana, obviously not in good shape. Florida, I would expect them to have major problems. Georgia, we'll see. The mayor is fighting of Atlanta is fighting with the governor. The one bright spot might be Mississippi. We'll know in about a week if this is just a measurement anomaly and then it has corrections, or if Mississippi really has started to flatten their curve. But in general, these states, we're all connected by a highway system. There's still a lot of transportation going on with trucking. My concern, and we've learned that the food supply is at some risk. My concern is that these states spur a non-flattening of the curves that we need to see flattened. So the reproduction rate of coronavirus, COVID-19, is measured. This is all 50 states, and it's come down with the social distancing. But we were basically passing, for every one person that had coronavirus, they would infect more than one person. That's a horrible thing because that multiplies, right? That's exponential. So in the last month, this has come down to, it's just a shade, when you aggregate all these, just a shade under 1. So if you get it, you're going to give it to one person, which holds everything steady. I'll show you in a moment why that's horrible. And if I'm right, or if my fears are justified, I should say, what's going on with the reopenings could spur this reproduction rate to go back up. There is a natural decline that will occur in addition to the social distancing measures. What we really need to see this curve get down to, or get down to, is this big group needs to get down to here, so that if 2 people have it, they only give it to one person. Or if one person has it, every other person doesn't pass it on. So we need the reproduction rate to fall down to about 0.5. Otherwise, the disease is setting up for a second wave at some point. And the CDC and WHO and everybody else suggests that that will be in the autumn. So remember when they first came out and said, if we don't do anything, 2 million people could die? And then they came back and said, okay, it shouldn't be that bad, but still between 100,000 and 220,000 should die. And then a couple weeks later, because there was pressure, they said, oh, it's going to max out at 60,000. Well, we're at 60,000, and really we're probably pushing 100,000 because of the uncounted people who did not get tested. And that's just, like I said, keep that in mind, is we're undercounting because people who don't get tested don't go into the official numbers. And I'll show you the New York chart one more time, I suppose, to make that abundantly clear. All right, so on this chart, they show that the official deaths are a little over 18,000, but related deaths puts the number at 23,000. And when you take a look at what the New York Times did, the number is actually higher. So probably, another 6,000, give or take. It's not a pretty picture. So IHME estimated back on April 17th that we probably have about 60,000 deaths and max out at about 72,000 in August. So we're blowing through the IHME estimate right now, and we're tracking to the high end of their range, which is around 100,000 deaths. You can see that this curve is almost completely impossible for it to flatten out like that in the next 2 to 4 weeks, which is a shame. But it's just not reality. It's looking like it's going to point up. Would it be nice if it turned over? It would be nice, but so much pressure is being put on reopening that it seems like that would be impossible. So the guys at MIT and the ladies, the ones who beat Vegas, right? You've seen the movies, how they went to Vegas and they crushed them at blackjack because they knew the odds. Well, they've been using machine learning, artificial intelligence, to put together their projections. And they, on their website, and this is a link here, so if you get this digitally, you can click on this, and you can go to the website for MIT and go through everything that they discuss. And they go through the IHME model and all the other models, and they discuss why certain things are what they are. I would, if you want to take a look at projections that I think are probably the very best out there, go to the MIT website, and they will put you on a range. Now, I think the upper range is a worst case scenario that would indicate a number of things. One, that the disease comes back. Two, that we are not keeping our distance from each other. So basically, we'd have to do everything wrong, and the disease would have to be more just a much worse disease. So we need to keep in mind that there is a worst case scenario that we need to try to avoid. And the social distancing is one of the things that is been working. And one of the concerns that I have, having been an athlete back in the day, still play competitive cards, is you never want to take victory, right, and give it away. You never want to snatch defeat from the jaws of victory. And by reopening just a month too early, we could be doing that. And while I understand that people say, well, I need the money, and they glom on to economic ideas that they don't understand, which I'll show you in a moment, and they feel pressure financially because trickle-down economics hasn't worked in 40 years, they feel as if, well, if I don't get back to work, if they don't reopen this economy, I'm in trouble. Well, we have extensive benefits for people for 4 months. Those should be extended, and it's probably right that they be extended, but people need to put pressure on the Mitch McConnells of the world who want states to go bankrupt to use that money. So if we can conjure $6 trillion out of the air, which largely went to medium and large businesses through bond programs, why can't we conjure another trillion to make sure that nobody loses their home and is fed and can pay their utility bills? So it becomes a measure of what do we prioritize, and there's no reason why small businesses have to be lost if we support them the same way that we're supporting the bond market with trillions and trillions of dollars that at some point are going to find, some of those dollars find their way into executive coffers, executive pockets, and shareholders and debt holders. So if we're going to bail out the big guys, there's no financial reason why we can't bail out the little guys. So keep that in mind when you're having your Facebook arguments or you're trying to think this through about what is affordable and what is not affordable. During the Great Recession, we had to spend our way to get out of it. We went on a 10-year boom that has been turning over for about a year and a half now. Largely, I think, because of the deficit spending induced by tax cuts, right? We got a jolt and then it turned over, which I said 3 years ago would happen, and it did. And I will show you those charts in a moment. But consider that if we can get $6 trillion like that, and it would cost maybe another trillion to make sure that everybody in the country was okay for a couple of more months, maybe we should be focusing on that rather than opening up a can of worms that could make the worst case situation more realistic. So the projection here from MIT is that we pass 100,000 deaths sometimes this summer, and in fact get to around 150,000 deaths by August 1st. With good mitigation, we could do the low end here. You see how that flattens out over the summer. This is what we should be targeting, the low end of this range. As of right now, I am very skeptical that we'll hit the low end of this range. And I think that the middle of the range is probably most likely. But If people demand it and a third of the population decides to not cooperate, then up here is more likely. And I'll say this as bluntly as I can. If you have a grandmother or an uncle or your parents, and any of them have any cardiovascular problems at all related to diabetes or high blood pressure or anything, you should give them a call and tell them goodbye. Because if we don't knock this down now, the odds of many of those people being alive in a year are pretty low. Stock markets rallied. We get a lot of headlines, but headlines are not treatments and vaccines. So when you see what Gilead is doing, that's great. Half of the people who are dying may not die now as they get those dosages out in the next couple of months. That's spectacular. And I've told you, I have a lot of faith in our biotech community to solve this. And I think originally, what I told you a month ago, 2 months ago, must have been in March. I think it was in March. So about 6 weeks ago, I told you, I think that we'll actually have a vaccine by the end of the year. I think we might have 2 or 3 that take different approaches. So if we get a vaccine by the end of the year, and then manufacturing is up and running by maybe, spring of next year, we could be doing mass vaccines by next summer. However, the odds of us getting there any faster are almost zero. And the odds of the vaccine getting here after that by a quarter or 2 quarters or a half a year or a year are pretty high. So we need to consider that what's going on now with the economy. Okay, let's throw out the fact that a lot of people can die. But what's going on with the economy is not going to be short-lived. So the race to a vaccine, this is from the New England Journal of Medicine. There's 6 really good candidates that are already going into human trials. The one that I find interesting is Moderna, because it's a different approach. Different approach to doing things with RNA. It's a good platform that works quickly. So we'll see that could be very interesting. The DNA-based model over here at Inovio, very interesting. But again, phase 1. These are all phase 1. To get this done in under 2 or 3 years would be phenomenal. It would be off the charts, unbelievably fast. But it also means that especially the people taking these treatments the earliest are going to be guinea pigs. Because even though the trials are usually pretty good, if we're rushing them and doing them with smaller samples and not asking all the right questions to become apparent over time, these could be dangerous. So don't believe as an investor or as just a concerned citizen that any of these are likely to be dosed to the population any sooner than about a year from now, and probably a little longer. So what should an investor think about in the face of COVID-19? Will the economy be hurt or helped by reopening it sooner? I would argue that the economic impact of reopening is small, but the risk is high. If you're a gambler or an investor, you know that's a bad equation. You want the potential positive impact to be high and the risk low. If you've ever taken an economics class or a business class or run a business or read anything from Warren Buffett or Seth Klarman or anybody who's made a lot of money in their life, they tell you it's not about taking a lot of risk that makes you money over time. It's about finding the things that could make you a lot of money and really can't lose you much. The same can be said here. If for some reason this first wave extends, right, and it shouldn't if we do things right, but if we do things wrong, it will. And then we get another wave in the fall because we didn't beat it down enough the first time, you get rolling waves, right? The crash onto the shoreline ends up being very big and very rapid. So if we have to shut down the economy again in 3 months or 6 months, and it doesn't end up just being rolling hotspots, but it ends up being as bad as it was in the last month, the economic destruction that I forecast back in April would be about $3 trillion, and everybody caught up with me on that, right? Most of the projections were $1 trillion or $2 trillion, and then finally got ramped up to $3 trillion after Jeff Gundlach and Goldman Sachs jumped on that bandwagon. Could become 4, 5, 6 trillion, 10 trillion. So the risk is big in reopening too quick, and the economic positives are low. And given that the economic positives are low, potential economic positives are low, why wouldn't we just print the extra $1 trillion to make sure everybody was okay to the end of June or July, right? So I'm very concerned that we could see some massive run-ons that'll become apparent in the next month probably, right? If these curves don't start to bend, market's going to know that, right? People look at this stuff. What did I tell you all of last year, especially after Labor Day? What should we be watching? We should be watching employment numbers, correct? So I don't know if this is easy to see here, but that's the spike up in unemployment. And that's not even including this last one. This is the employment index, right? Look, it started to fall in 2018. So early in the year when I did my forecast, I told you we're on thin ice already. I don't know that it would have gotten this bad, right? This far right-hand side without COVID-19. But look where it had gotten just lately. So employment strength hasn't really been there for over a year. Consumption is falling off a cliff. Real per capita income is falling off a cliff. And this is what we should be shoring up. We should be giving people more money. The unemployment benefit should be extended, especially the extra $600 a week. And the president should come out and say, look, we're going to make sure you don't lose your house. Here's how we're going to do it. And it has to be direct transfers. It can't be or you put this month and next month and the month after, you put 3 to 6 mortgage payments at the end of the mortgage. And then you fund the banks to make that happen. You say to the banks, you're going to do this. Here's an interest payment that you were going to make. Keep it. These things aren't hard to do. There has to just be a willingness to do it. And if people weren't so afraid, maybe they'd speak up. Rather than saying, yeah, give the money to the big guys. It'll trickle down to me. Anybody who's been around since the 70s and 80s, right? If you're in your 70s right now, take an objective view, and you tell me, not just for you, but what you've seen around you, your kids, and the people around your kids, how well has trickle-down worked? We know that 80% of the population can't afford a car repair. Back in the 70s, and until about 1980, even with stagflation for a few years, I have a client who's a trustee of the ironworkers who I'm actually going to go see this afternoon. And he said, if we worked overtime for a summer, we could buy a car cash. How many of you can work overtime for a summer and buy a car for cash now? Speaking of that, little side note, just to accentuate how much spending is going to fall off a cliff and already is, the car glut is off the charts. So you're not going to see the car companies start to manufacture, pedal to the metal anytime soon. And in fact, when PPP expires and companies can start laying off again in October or in September, it's one or the other, you should expect to see even more layoffs that become permanent. You know that I'm high on Ford. Why am I high on Ford? Because they have a loyal built-in base. A lot of those people, when it comes time to buy an electric vehicle in the middle 2020s, which is what all the companies and the government are targeting, Ford's going to be a leader there. Why? Because their Ford Mustang Mach-E, which I, put my grubby hands on at Consumer Electronics Show in Vegas a couple of months ago, I'm telling you, it's roughly the equivalent to the Model Y from Tesla. It's not quite there yet. They need probably a year of data to catch up, but it's going to compete well with the Model Y. And one of the reasons it'll compete well is that it's close enough and it's a Ford. And all those Ford people will buy the Ford because they don't like Elon Musk, who, frankly, I don't even like. I admire that he's helped change the world at a time that I thought the world needed changing. But the guy's a prick. And frankly, I'm not going to buy a Tesla. I'll buy a Ford. That's just the way it's going to be. And I think that's going to be the case for millions of other people. So Ford, as it goes down to $3 or $4 a share, there's going to be a place to buy it because it's not going out of business and it's not even going to go bankrupt. And they have the ability, with their fourth industrial revolution of technology that I've talked to you about since January, to start making other things. Ventilators, anybody? Robotics? Ford is going to become a more diversified company and lead in electric vehicles, and they have all those showrooms. You tell me that they can't sell something else out of those showrooms. Solar, batteries, roofing. They have the space, they have the people to do it. They can shuffle their employees around. They can work with the union to save the company. And they have the money to wait this out and the technology. So while they may not hire in the next couple of years, and they may have to lay some people off, most of those folks will just need job training, right? They have to recalibrate their skills. But they were already using the fourth industrial revolution machine learning technology. They're just going to build a new widget. They'll build a ventilator. They'll build an aerospace part. Maybe they'll compete with Roomba. Build little vacuum cleaners. Who knows? Ford's going to go through a major transformation if their management has any sense, and I have the impression that they do, because they're talking about all the right things, they're asking all the right questions, they seem to be doing all the right things, despite pressure from the White House to do the wrong things. Because consumer confidence is low, because their incomes are falling, production and orders are falling off a cliff. PMI manufacturing started to fall over a year ago. This is just going to keep it beaten down. ISM new orders started falling over a year ago. It's going to stay beaten down. These are Great Recessions type numbers. And pent-up demand takes time, right? The real estate market didn't really even bottom during the Great Recession until 2012. Did you know that? The winter of 2011, 2012 is when real estate actually bottomed off the Great Recession. I wrote an article back then. If you Google gift of real estate, my name at the end, Spano. An article will pop up somewhere that tells you to, hey, get into a partnership with people and buy real estate. I think that that's coming too. So you're just going to have to find out, at what point does it make sense for us to buy real estate? And not necessarily residential, although I think that's a great deal. You've heard me talk about, buy at the outskirts. There's probably a lot of, oh, there it is. I was looking for this. There you go. December 2010, wrote a special letter. Give the gift of real estate. I told people to get into partnerships and buy real estate. This was about a year before it ended, before the bottom was in. Anybody who bought real estate these 2 or 3 years did really well. In the short term, though, we have problems. The oil industry is going to continue to default. Even the bailouts they're talking about are only for the investment grade companies, which isn't many of them. And that's going to resonate with the bond market and the banks. Retail and office real estate is going to feel the strain of rent payments not coming in. You've seen those articles. Dividend cuts, mortgage defaults, which rolls downhill to the bond market and the banks. And then with lower consumer demand, many companies are going to go through bankruptcy, defaulting on debts, which rolls downhill to the bond market and the banks. Get the point? The Fed is going to have to focus on the bond market and the banks. Otherwise, we'll have a credit seizure that doesn't allow anything else to happen. But again, you might as well throw in $1 trillion and make sure nobody starves. Internationally, you're likely to see a flight to safety. Dollars are already becoming scarce. The dollar is high, likely to go a little higher in the next several months. Emerging markets, which have most of their debt denominated in dollars, need trillions of dollars. I think the number I read was 3.6 trillion. Or they're going to have to default and renegotiate. So when they renegotiate, that's really a default by another name. The EU is in big trouble. One, they just have coordination problems, and two, they're just in worse shape than we are by a long shot. So I think that the EU, and Lagarde is very willing to do this. They're just going to have to print a ton of euros and spread them around and hope that Germany doesn't revolt. And finally, internationally, China, which is the other large driver of the international economy, it's basically the international economy is about a quarter of the United States, a quarter China, and everybody else is half, right? And actually, half of that half is Japan and Europe, a little bit more. So China, which wanted to become a consumer economy, has a problem right now because their unemployment is high too. So the Fed is doing everything they can to keep the bond market from collapsing and the banking system to fall into chaos. They should succeed because, as we've been told, they have infinite money and they'll use it. However, those who think that the Fed will start buying stocks, keep in mind, that's illegal. It would take an act of Congress, and I don't see the House of Representatives saying go ahead and buy stocks. Now, at some point, I think an entity of the United States government should buy stocks on a gradual basis through payroll. What do I mean? I've told you that we need to bail out the retirement system at some point, or just tell a whole generation of people to piss off. I don't think that's going to happen. It'd be very easy when the next bailouts come. They have to do with the retirement system, and maybe we should just do it all next year. I think we should create that lockbox and let Social Security put about 20-25% of their money into the S&P 500. That incentivizes good behavior by companies, right? Because you have to meet criteria to get into the S&P 500. And it generates a lot of long-term wealth creation. And if we have a quarter of Social Security gradually get into the S&P 500, and about a quarter is the right number based on risk metrics, right? You want to have about 3/4 in bonds and a quarter in the stock market, and the real estate that both things are related to. And over time, you'll offset inflation. You won't grow a lot, but you'll offset inflation, which is all Social Security should do. Shouldn't take much more risk than that. And if you hold for very long periods of time, we know the stock market goes up, and clearly the government's going to print enough money that they would insure their bet. So there's a way to bail everything out and secure the retirement system if they have the willingness to do it, rather than saying, let's cut benefits and let states go bankrupt. Because those two things would cause a depression. So what Mitch McConnell said a while back about let states go bankrupt, that is a guaranteed recipe for a depression. I don't know if he's evil or if he's stupid or he's greedy or all or some. I don't know. But letting states go bankrupt causes a depression, and telling people live the last 20 or 30 years on even less, that'd be bad too. And what does that do for confidence in the American system? I think it drives us closer to socialism, right? The snapback. When you take things away from people that they feel like they earned, the snapback could be very violent. So, some other things that we should consider. The number one marginal buyer in the stock market the past 4 years has been the corporations themselves buying back their stock. I told you that those buybacks would, at least half of them go away this year. Goldman Sachs, again, within a couple of weeks of me saying it, jumped on the bandwagon. It's almost like I should work at Goldman Sachs, or that maybe I know somebody at Goldman Sachs and we talk about things. I believe that buybacks will actually fall over 70% this year and start to trickle back in for some companies next year. Apple last night said that they're going to have a problem. Amazon, which hasn't been buying back shares, said we're still not going to. And we're going to have to reinvest all the money that we've made because we have impacts too that are negative. So for all the new business that went through Amazon, they haven't made a profit on it yet, because the costs met the profits, right? The costs went up as much as the revenue did. So that leaves a lot of downside for stocks if the buybacks are gone, if revenues are going to trend sideways to lower for a year or so. At some point, and the Fed truly just can't bail out the stock market at this point. This is way bigger than the Great Recession. The magnitude is much, much larger. Again, take a look at the unemployment numbers. You don't see this type of unemployment ever in history. Ever. Not even the Great Depression. And even if half of these people get their job back by next summer, a year from now, that's still really high unemployment. This is going to persist for a couple of years, and that'll be pressure on the end economy. Eventually, earnings matter to the stock market. So just some final thoughts. What should we be doing? We should be spending another 6 to 8 weeks on a pretty strict lockdown to try to get the spread rate to about 0.5. That would push the death rate down dramatically. It would give people confidence, which is important to get them back into the economy. And then people would start going back to work over the summer. And the economic relief needs to be focused more from the bottom up, not top down. We said that during the Great Depression, the Great Recession, Everybody said, why didn't they just give everybody money for their mortgages? That would be a great solution too. We learned from last time, everybody said. Have we? Are we just making similar mistakes? For the magnitude of this problem, our improvement in dealing with it has not been that good. I want you to keep something in mind. Back when I talked about stagflation, the presumption 10, 15 years ago was that eventually the United States would have to devalue their debt by about a third. If debt matters, right? Dick Cheney said debt doesn't matter 35 years ago, 40 years ago, whatever it was a while back. It was in the early 80s, I remember it. I was a kid, and I remember seeing Dick Cheney on TV, and then I read about him in college. I was like, huh, who's this guy? The pressure of lower incomes, and business owners are going to have to do this, is a spiraling downhill effect. The answer is helicopter money. There is no way to grind our way out of this. Not quickly anyway. It'll take years. Next year, I believe that we're going to get the mother of all stimulus. We need to be prepared for that too, because where to invest ahead of that is going to be a big deal. In the meantime, the stock market's going lower because we aren't doing what we should be doing. We're not suppressing this as much as we should, and we're not bailing from the bottom up. But after President Obama did the things that he wanted to do, we went on a huge rally for a very long time. It wasn't a spike, but it was better, and it kept getting better until last year. So how low can the S&P 500 go? Now, my Elliott waves aren't particularly elegant. I don't even use them for much more than trying to figure out the end. And I don't use Fibonacci numbers unless I do swing trading. These are broad confluence support levels. What is a confluence? A confluence is when multiple support levels get on top of each other from different time frames. So these lines show where the support in stock market is. Low 230s, I think, is a done deal. We're going to get that. 215, in the 200 and teens on the S&P 500, right? I think it's a pretty strong possibility. Between these two red lines, it's where the Elliott waivers think we're going to end up. I tend to agree with them. Now, if some of these curves keep getting worse, and I don't think we're going to see the worst case scenario, but I don't think we're going to see the best case scenario either, we could end up between these two red lines. Either way, you're going to need to scale in somewhere in here because we don't know when it reverses, when the next $1 trillion hits. So between the yellow line and the red line is the buy range, probably buy at 2 or 3 different levels. Now, there is an Armageddon scenario. The Armageddon scenario is disease is worse and we're worse. Our response is worse. The S&P 500 could go all the way down to the very low 1,000s. It could even go under 1,000. Now, that would be a 2/3 drop. I want you to kick something around with me. Is it even possible for the S&P 500 to drop by 65, 70%? Oh, it's possible. Here's why. There's about 100 companies in the S&P 500 that I don't think are worth anything. Literally, I think they'll be gone, merged, bankrupt within this decade. They don't have growing businesses. They have high debt. Now, as they fall out of the S&P 500, they'll be replaced by growing companies, but this will take years. You're going to see a lot heavier technology weighting in the S&P 500 in 3 or 4 years. And the first wave is coming in June, and we have a list of stocks for that, right? So we'll be talking about that on Tuesday. Tuesday is the stock call for everybody who's a member. That one will be private. If Apple and Amazon and Microsoft and Google and Facebook, those 5 companies, if they lose 50%, and then these 100 companies lose 60, 70, 80%, that is your stock market down by 2/3 from here scenario. I don't think it's likely, but to dismiss it as a possibility is arrogant. And to think that this level C, this wave, this correction can't get down into this area, 150, 160, 140, on the S&P 500, it's not terribly far-fetched. So while I don't think this is likely, it's possible, and this is probable, and this is pretty possible. You need to keep these things in context, because over the last 2 weeks, and it's been the same dozen people calling you out, should we buy? Should we buy? Should we buy? Are you going to help me buy? Get a grip. The economy is in bad shape. People are going to be out of work a long time. You had a bunch of traders trading, sucking people in. Stop being a FOMO sucker. Get your FOGAC. Get your fear of missing out or gone. Get some fear of getting your assets kicked. Those of you who have listened to me for the last couple of years know I'm trying really hard not to swear. I'm trying to be a better person. Like from Pulp Fiction, trying to get better. This area, I think, is where we end up. This is possible. And don't pretend that this can't happen. So keep your eyes open, just in case we start doing all the wrong things. We're humans. We do the wrong things once in a while. But always remember Winston Churchill. Americans, we always end up doing the right thing after we try a lot of other things, right? I think that's what Churchill, that's a paraphrase of Churchill. You can trust the Americans to do the right thing after they've tried everything else. We'll get around to doing the right thing. How much pain do we have between now and then? This is the Financial Times today. Stocks started to tumble. U.S.-China slugging it out. I told you that would happen eventually. I didn't know the coronavirus would be the flashpoint, but I think it was going to happen anyway. I wrote about it way ahead of coronavirus. Oil. Chevron slash spending. Exxon slash spending. Royal Dutch Shell, who people asked me about and said, I'm going to buy Royal Dutch Shell, and I told them not to. What did they just do? Royal Dutch Shell cut their dividend yesterday. The end of the office? Not exactly, but it'll change. The work from home dynamic is changing everything. And businesses are finding that it didn't hurt productivity. Productivity was already mediocre. Might as well let them stay at home. Because nobody allows themselves to be browbeaten anymore, unless you work for Microsoft. Maybe Google, I don't know. A lot of just getting by out there. You can just get by at your home desk and not have the company pay for office space. Right? Bad for office space. Who is what's going on bad for? So between the work-at-home economy and taking a break from crowded settings, who's going to see the hit from this? Hotels, casinos, cruise hotels, live entertainment, movie theaters, really everything related to tourism entertainment. Look at this graphic I pulled. 99% fall in table seatings worldwide at restaurants. 99%. It's almost 100. So, you know, I mean, come on. Airlines, verge of bankruptcy. Automotive companies, right? And all the trickle down. We've talked about how the automotive industry is connected to so many other things, right? It's not just the manufacturer, it's all the equipment, it's all the services, banks, the food chain, right? We're having a problem with meat processing. Global trade and shipping has fallen because of the falling demand. Oil, right? It was a negative. Oil was negative a week ago, 2 weeks ago. Negative. If you had an oil drum, they'd give you the oil for free. In real estate, certain real estate's going to do fine. Certain real estate will come back sooner than others. Other real estate, take a look at the malls and other properties that after the Great Recession never got redeveloped. I would argue that those are the types of properties you should look at in the next couple of years if you want to invest in little groups. And I'm going to put together a real estate investment group in the next year or two because I just think that the opportunity to redevelop as the economy comes back is going to be pretty outstanding by the middle 2020s. I think that residential real estate that's not quite city center, redevelopment of neighborhoods around park settings, small towns are going to come back, right? Because nobody has to drive to work every day anymore. Not if you're an office person. There will be a lot of people who only have to go into the office once or twice a week going forward. That's going to change a lot of dynamics. A lot of those small towns that died are going to come back. Why? They're nice places to live. And if you're within an hour of the big city, 2 hours, whatever is normal to you, right? In Milwaukee, if I'm not within an hour of Milwaukee, I'm thinking, oh my God, I'm driving a long time. But when I go to Phoenix, it's an hour to get from one side of the city to the other. So I get it. Or in Vegas is almost like that too. So these are all things that are hurt. You want to avoid these in your portfolio. Here's what's going to do well. Technology, communications, cloud, right? Anything technology related. Biotech and pharma. Although don't get caught chasing dreams, make sure that there's numbers behind your investments. Delivery services. Don't think that the pick up and go or the delivery service economy is going away. It's going to just keep getting stronger, especially now that people like me, I've ordered from Kroger. Oh, flash alert, new stock, Kroger. Talked about food stores a couple of years ago. Kroger. Some people might want that one. Go pick up my groceries at the curbside now. Go on my little phone. I say, okay, these are the regular things. You start with that. It's right in the app. You go, okay, these are the 17 things that I always buy. And then add this, 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 and this. It already knows the 17 things because it's just in there forever. And then add this, this, and this because this week I want this and this week I want that. Bam. You show up 3 hours later. It's in bags for you. You double check it to make sure they didn't give you the crappy apples. And there you go. Home building is going to be for crap this year, and a lot of those stocks are going to get beat to crap. We're going to want to buy those because the pent-up demand for single-family housing was already pretty high, and it's going to get higher because people are going to move out of the cities. It's already starting to happen. Then logistics. Logistics isn't going anywhere, and with delivery and supply chains moving, I think that we can find some opportunities there. With regard to supply chains, again, we talked about this all last year. Machine learning is really what's driving the move of supply chains. So if it's safer for a company to produce in the United States, closer to its end consumers, and the robots here are just as cheap as the robots there, and the difference in the cost of the engineers is negligible, or the people running the machines or fixing the machines is negligible, at least less than the transportation cost of moving the widget from China to the United States, all things being roughly equal on the finance side, on the money side, why wouldn't you produce closer to your end client, your end customers? So while we can say it was the tariffs and the trade war and coronavirus that moved the supply chains, those are just extra. The supply chains have been moving already because of machine learning. Because the machines can do a lot of things that we needed a lot of people to do in the past, right? And what's interesting is that the new jobs are better than the old jobs. Require more education and more training. But think about all the skilled trade people and people who are fixing things and working at tool and die shops, CNC machines and whatnot. They're all smart people. They all have really good mechanical aptitudes. Easy to move them into the next widget. Think about people at Ford. Whether they're working on an assembly line with robots to build cars or build ventilators, what difference does it make? They're just building a new widget with the same technology. So this fourth industrial revolution is going to be very good for America. Why? Because we're a quarter of the economy, global economy. And while that will drift down over time as the rest of the world consumes more, having the supply chain here in a country that's rich in resources, safe, the skimming is out of hand right now, but manageable in the long run. Legal system is decent, right? You got labor. I mean, the United States, you just can't beat it. And I just want to throw that out there. For all the complaining I do about some of the stupid things we do, it is hard to overcome the fact that we just do almost everything better than everybody else. And that's not because we're better than anybody else. I don't think we are. My version of American exceptionalism is that we got a good piece of rock, right? I learned that from the oil industry. A lot is tied to the land you're on. We got the best land in the world. It's fertile. We got resources. We got open spaces to recreate and stay safe. All the little towns out there that got abandoned in the 80s, 90s, and through the Great Recession can come back. The infrastructure's in place. You know, pretty soon we'll be able to read a book and drive at the same time, watch a movie and drive at the same time. You know, we'll get the level 4 autonomy, and on drives that you make regularly, your car will learn that drive. Right? If you just want to weave through a city that you've never been in before, keep your hands on the wheel. But the whole from point A to point B, I go from here to the grocery store, I can just say, hey, car, take me to a grocery store. Which one, Mr. Spano? Oh, let's go to the expensive one this week. I feel like a good piece of fish. All right, drives me there. Or, hey, I just need to make some pasta. Take me to the cheap place. Whatever. So these are the places we're going to want to focus on. And this is really derivative of that investing in the 2020s report that I did, except that all the timelines have changed now. So your asset allocation, avoiding a lot of this stuff until it really bottoms, and then you can cherry pick, but really focusing on this stuff, right? Maybe we want fertilizer after this year, right? I don't own much nutrient anymore. Why don't I own much nutrient anymore? It's a company that's been on my list. I love the company long term. However, the farmers are running a scam right now. They're not going to fertilize their fields because they make more money on the insurance than selling the crops. So they're going to plant because they have to qualify for the insurance, but they don't give a shit if it grows. Oh, quarter in the jar, I swore. You know, I love Delta Airlines long-term. Why? Because I think they have the best technology and they're smart enough to buy their own refinery. And I just think they're a better airline than almost any other airline. Well, who's going to fly in the next year? Yeah, a lot of retrenching. And Boeing, they're having orders canceled left and right. I mean, that company could shrink by 50%. What kind of share price does that really support? When I told people that Boeing could go under $200 a share a year ago, I got laughed at. I don't even know what it is right now. Is it like 120? I have no idea what Boeing is right now. BA, 136. Right? And I was telling people to go down under 200, back when it was way in the 300s. How can you say that? Well, it happened. You have to understand what underlies a business to invest in it. And that's something that most people don't do. Most people don't read the corporate reports. They even skip the investor presentations, which are in 30-slide decks, like this one. You can look at a presentation and listen to the conference call for an hour, and you know more than 80% of the investors out there, maybe 90. All right, some trades to make right now, and we'll finish up with this. If you didn't sell before the coronavirus crash and you're still too heavy in stocks for your risk tolerance, trim today. Maybe a little today, maybe a little on Monday. Who knows? Maybe the market goes up on Monday on some hopium. Right? There's lots of hopium out there. Sell into it. I've been telling you that for weeks. If you traded the April rally for gains, take your gains off the table and maybe even a little bit of your principal. I didn't look up the word principal this time. I always forget. I don't know how I forget that for 30 years, but I forget how to spell it. Sell long dated covered calls. So here's a really interesting transaction that I like a lot, and I've talked about them. I think that if you sell long dated covered calls on your holdings, like on Nutrien, if you don't want to sell Nutrien, and it really only has like 20%, 30% downside, go ahead and sell a call 10% higher than today's price, 15% higher than today's price. Go all the way out to October or even January and collect all that premium. Right? If you're committed to the stock, and it pays a dividend, so I think the long dated covered calls are best for dividend stocks. Sell a long dated covered call to help get you through the volatility. It's a good way to go. Lots of stocks you can do that with. Just remember, if the premiums aren't high enough to make it worth your while, then you're better off trimming. So you have to make a measurement of where the premium is. Is it worthwhile to sell the call, or does it just make sense to trim the stock and then buy it back later? And here's some more exotic things. Buy some dollars and some gold. People always say, well, if the value of the dollar goes up, the value of gold goes down. Well, if you take a look at the charts, they move in tandem from time to time. It's usually event-driven. We're in an event. We are in an event, right? So the dollar is likely to stay strong until later this year. So selling puts on UUP is a worthwhile idea. And you could, if you understand that it's a trade and not an investment, you could buy some UUP, which is an ETF that goes, tracks the dollar. But I think the better idea, rather than even buying UUP, other than buying the gold and gold miner ETFs on dips, which we've targeted the middle 20s on GDX, right? Sell the euro, right? So you can buy puts on the euro. I said this, I'm trying to remember the year that I made this big euro trade when it dropped from like 130 to 112 or something, whatever it was. I think the euro is going to trade below the dollar soon. Think about that. As much economic stimulus as we're going to do, the Europeans have to do more. And Europe is in such a problem spot right now that they want to keep the euro to be a little bit more valuable than the dollar. They're just not going to be able to do it anymore. This crisis is going to be much worse for them than it is for us. So I think you can bet against the euro. And I think that it's a good bet, and I think it's a low-risk bet. Because even if you don't win, you ain't going to lose much. That's a good risk-reward equation, right? All right. Sell financial, home builders, oil, and Australia. The banks are going to get hit hard by this, and it's going to get worse. Most buybacks are going to be eliminated, and a lot of dividends will be frozen or cut. The home builders, they're going to have a rough year, man. Just a rough year. But I think that they might be one of the ones that come back the best and the hardest. So this is definitely a trade, right? Short-term, pessimistic on home builders, but long-term optimistic, right? Flip it. You're going to have to flip it. Or ignore it for now and then just buy it when it bottoms, right? Nobody says that you have to play the short side of the market. It's a hard side of the market. Sometimes it's just better to have extra cash and wait for the opportunity to be a bull. So if you're a bull by nature, don't try to be a bear, right? Bulls and bears make money, but pigs get slaughtered. So don't do something that's outside of your nature. Sell all your oil stocks, all of them. I've been telling you this since January. I was watching the economic numbers. I knew that the only thing that saved oil was a war. And now, even a war in the Middle East won't save oil. Why? Biggest glut in history. We got EVs coming in 5 or 6 years. Oil is never, ever, ever going to $100 a barrel again. Ever. Maybe the 2040s or 2050s. But for us, next 20 years, they ain't going over 100. The inventory is too high. Anytime price of oil gets to 60, who's going to produce the oil? It's going to be Saudi Arabia in the Middle East. Why? They have the cheapest oil. They're never, ever giving market share back to us. Ever. Why? Because our oil's not cheap enough. Fracked oil is $40 to $50 a barrel, and the price of it is going to go up because the technology can't offset the fact that we've already gotten the cheapest, easiest to get oil. We high-graded all the oil fields. Colorado's in bad shape. Oklahoma has earthquakes. The Bakken, we sip, the straw's been down there a long time. You've got the Permian, right? And weirdly, the company that probably comes out of this the best after bankruptcy is probably Occidental, because they have all those conventional assets, right? Occidental started as a conventional driller. So if they go down to $1, that's when you have to start thinking, do I buy it right before they go bankrupt? Or do they just do a massive devaluation and they don't completely wipe out shareholders? If that stock gets down to $1 and you don't think they're going to wipe out the shareholders, then don't hope. Try to figure out what Icahn wants. Figure out what Carl Icahn and Warren Buffett want, because they're the two big guys in that stock. Warren Buffett just got all kinds of shares issued to him as a dividend. So my guess is that they don't wipe out the shareholders. They just devalue, right? They dilute by a lot, because they're going to have to get rid of, I don't know, so like $20 billion of debt or something they got to get rid of. So, I mean, that's a stock that if the market cap of the company gets down to $1 billion, your one share will be worth, your 20 shares will be worth one share after the dilution. Maybe a 20 to 1 dilution, maybe 50 to 1, who knows? Somewhere between 20 and 50 because of the amount of debt. And sell Australia. Australia is a resource and tourism-driven economy based on China demand. They're screwed for a while. They're about to have their worst recession in like 3 decades. So keep an eye on that. I will have separate trades built into the back end of this, and I'll have this to everybody by Sunday, because I'm going to take a little time off. But remember, the sun will come out tomorrow. Hopefully we do all the right things. Probably we won't. And we'll have to take some lumps along the way. I put out the global trends asset allocation, and you noticed about a week ago I put that out. 76% out of the market. You know, risk management. I know there's people out there that just can't let go of things for a loss. Keep this in mind. Old Wall Street wisdom. You don't have to make your money back where you lost it. All right, so we're going to finish up. On Tuesday, we'll have the stock seminar version of this. We'll actually go through some charts and really explain where I see how to buy these stocks and when, which I don't think is in the next week. So we got time. And I don't think the ETFs you're going to want to buy in the next week. So we got time. Today, look at your portfolio. If you have 30, 40, 50 stocks, find the ones that you don't like the most. Not because they've gone up or down, because of what you know about their businesses. Where do they fall in this continuum, right? Are they in here? Are they in here? If they're in here, you're going to have to wait years to make your money back. If they're in here, you make your money back a lot faster. Probably keep these, sell some of these, then either A, buy these back cheaper. You know, I think Ford is going to be a buy at some point. I think Delta is going to be a buy at some point. I think a couple of the casinos will be buys at some point, right? Because people like me can't do without it. I don't think oil's ever coming back. I think certain real estate, you don't want to own the stocks in the REITs. You want to go find 10 of your friends and set something up so that, hey, we can, buy a building, redevelop it, and people you trust. Make sure you have a structure. This is where the money is. All right. That, by the way, is Lake Michigan on a winter morning. The once or twice a year where I actually drive down to the lake to watch the sunset, it's pretty cool. I pick out certain days. Don't do it often because, that's early. Usually days that I go fishing, which I don't do often anymore either, but I should because fishing's pretty cool on Lake Michigan. If you can find the fish. It's an expensive proposition. It ain't cheap way. When I was a kid, we used to just take a bucket down to the shore and catch fish. Can't really do that too much anymore. All right, everybody have a great weekend. The world's going to get better. It always does. Take a look at the very short lists. The front page especially, the world gets better over time, even though we have setbacks from time to time. And let's do everything we can to protect each other. Because in the end, that's what's important. We can make more money, right? Money is like Doritos. We'll make more. All right, everybody have a great weekend.